Well, hello, everybody. It's good to see you. I am with my most present student, Lupita, here, who has helped me realize that the capital budgeting problem needs recorded. So she's going to follow along with me while I go through the process of capital budgeting. As we do this capital budgeting project, what I would like to do is indicate off to the side something that I think is a solid process for solving problems of this nature. Because what we're going to do is take all the principles we've seen before, including the income statement, including going forward projections, including the time value of money, and wrap them all together to help a corporation make a particular financial decision. So the way we're going to do this first is we're going to first read this problem together out loud, and then I always suggest that you read it twice. The most important part, I think, is always in the way that we're going to document the assumptions. So you've noticed that I've built for us already the text that we'll use to drop in all of the numerical values that we can assume. But again, what's critical in this step is the logic that you're going to use in which to organize your assumptions, which is going to make it easier for us then to project an income statement, because it's from that income statement that will determine basic things like profitability. But when we have an income statement needs to be converted into cash flows. Cash flows will be more specific to the cash that comes in and the cash that comes out. And what we're going to do with those cash flows is we are going to solve for what we call NPV, which is net present value, where what we will look at is basically, is the present value of the cash flows we get in greater than the present value of the cash flows that go out? If you keep a simple concept in mind, if Lupita had to hand $1 to me in order to be able to receive $2 back, the present value of her cash flows in are greater than the present value of her cash flows out. She would clearly trade me $1 for 2. So after we do that, then we can interpret what that means and make a decision. All right, so looking at the problem then, we're going to be looking at a small private company called Lily's Loving Laundry. A laundromat needs a new steam press at its facility because its manufacturing will include on-premises production. That press then will require the following two things. First, it doesn't just fit naturally, so you're going to have to do some capital improvements to the space, which are $6,000, and then you're going to have to buy the actual machine itself for $8,200. Both things are considered long-term capital investments. But as it relates to depreciation, we're only going to depreciate that steamer. And what we're going to think is that after 5 years of use, that steamer will have what's called a salvage value of $500. Now, what happened is Lily paid a designer, about $1,300 a few years ago to say, hey, I'm thinking about putting the steamer in. I'm going to need some draperies to hide it. How am I going to make the floor not look bad? And so she got some advice. Right now, then, here's what Lily's manufacturing operations look like. She launders 10,000 units, shirts, per year. Now, not all of those shirts are going to be pressed, just some of them. Some people like their shirts just cleaned, some people like them cleaned and pressed. She estimates about 75% of them would be eligible for that steam pressing. Right now, if you go there and you just get your shirt laundered, it's $4 to have that shirt laundered. But if you get it pressed, you will pay another $1.20 for those shirts. So $5.20 would be the total price for someone who wants a shirt laundered and pressed. Now, to have a steam presser, you're going to have to hire someone to do that work. And so you're going to hire someone and pay $9.50 per hour, and that person will only work 5 hours per week. and the person will only work basically every other week for 25 weeks. That employee is going to get a 50-cent raise per hour every year. The company is going to have to pay some income tax at 30%, and we're going to be looking to solve for NPV and IRR, assuming that if Lily did not spend the money necessary to reconstruct the space and install the steamer, she could just go ahead and invest her money, let's say, into a mildly conservative, diversified portfolio of similar risk, and she would expect to earn about 6%. So let's put this together and notice when we start documenting our assumptions, first thing we've got is all bold, all uppercase. Then we're going to go to mixed case and document assumptions about the income statement. Subordinate to the income statement, we'll think about then revenues and expenses. In addition to revenues and expenses, then we will eventually get down and make some balance sheet assumptions. And notice the assumptions that we make. I always like to put column B as my empty column for descriptions or for toggle switches or whatever I want to put in there. And then we'll deal with a 5-year horizon, periods C through G. Okay, so according to this, Lily currently has 10,000 shirts that get laundered, of which 75% of them will be pressed. That pressing will yield a new $1.20. We don't use the total $5.20. You just use the new revenue, because presumably these 10,000 shirts at $4 you're already getting. We just want to analyze the new revenues you would be getting for the pressing. Then as it relates to the production expenses, we are going to have one worker who in the first year is going to make $9.50. They're not going to get a raise at all in the first year. They're working 5 hours per week and making $25 per hour. Then we have to look and see, are there any other expenses related to this that are not production specific? Like, do they have to buy new insurance because of the steamer? Or are they going to advertise this thing? And when we look up above, we don't see anything specific. So there is no SG&A to worry about. And there is no interest expense because we're not going to borrow to buy these capital items. We'll use cash. But because we are buying capital items, they will depreciate. How is it that things depreciate then? That has to do with our balance sheet then. And in our balance sheet, what we had determined is that we are going to make a capital improvement of $6,000. We're going to go ahead and make that right away to start this thing off. And then we're going to go ahead and buy the steamer for $8,200. That steamer, let's see, how long is it going to last for? Do we have any specifics on that? Just will be depreciated over 5 years with a salvage value to $500. So it's going to last for 5 years, and then it should be $500 in the end, which means we have to calculate the amount of depreciation that will be charged each and every year. And the way we do that is by taking equals, and we start off with first the price that we're going to pay for the steamer. We subtract off from that the salvage value. So what that tells us is that we're going to depreciate only $7,700. If we then put that in parentheses and divide it by the number of years, what that tells us is we're going to depreciate this thing $1,540 each and every year. Now we're going to use these calculations again on a fixed basis, so I'm going to put my dollar signs around each of those so that when I copy and paste, it will always reference the values that are over here. I believe we said it was a tax rate of 30%. So again, the criticality in the beginning is being very thoughtful and logical about the way that you lay out your assumptions so that now we can think about going forward. Is it possible that revenues could grow over time? Maybe. We would have the ability to key in, hey, in the 5th year, we're going to sell 15,000 pressed shirts and 90% of those will be pressed. That isn't the case here, but we've built the flexibility into our model to do the same. Now, same goes for all of our values as it relates to our cost of goods and our wage rate, but we said up above the person who works there is actually going to get a 50-cent raise, so that in the given year it would be the previous year's wage rate plus a 50-cent raise, which then tells us by the end of this period that employee will be making $11.50 in that 5th year. So now that we've got all of our basic revenue and expense assumptions, let's go down and build our income statement that would apply to Lily's Loving Laundry. So revenues that they would get brand new would be equal to 10,000 shirts. 75% of those are eligible for steaming at a price of $1.20 per, suggests that this would be a new $9,000 worth of revenues a year. How about new cost of goods sold? You would have one worker working and making $9.50 an hour, working 5 hours a week for 25 weeks per year, suggesting a new $1,187 in costs. Therefore, when you take your new revenues minus your new expenses, your new gross profit is $7,812. We have no SG&A, but we can still go and point to this in case later on we make a determination that we need to advertise, or we need to, the landlord comes and raises the rent on us because we have new machinery in there, or something of that nature, so that when we think about our EBITDA is going to be, as of right now, the same as our gross profit. We have to then incorporate the amount of our depreciation in here so that our earnings before interest and tax would be 6,200 and change. We are not borrowing to fund this capital lease, but again, we could leave this there as a pointer in case we decide that we don't have $15,000 to do all the repairs and the installation and the purchase. So we go ahead and we bring that in so that we can get ourselves to an EBT number. It's this number then that needs to have tax applied to it. So the tax amount is going to be our EBT multiplied by our tax rate. So we're going to pay 1,800 and change in taxes, so that we can first assume that the net income on this new investment will be $4,390 each in that first year. Now, because we built the top so nicely, we should be able to copy and paste the bottom over and then just double check. Yep, we have no SG&A, that makes sense. We have no interest, that makes sense. And what we do have is a slightly decreasing net income over time. Why is that? Because we're continuing to pay our employee more over time, and so our profits decline slightly because our expenses are increasing while our revenues are staying the same. So now we have a good estimate on an income statement. And if we just took a bold look here, we would see that our total investment is going to yield us a $21,000 sum new profit. But those profits occur during a 5-year period, so we have to discount those to present using time value of money. So as I'm up on this process, we've read the problem twice, we've documented our assumptions, we just finished the income statement. Now we're going to put together this little cash flows model. So if we look at the bottom of our spreadsheet, here is where we're going to put together our cash flows model. So we'll use the basic principles of time value of money, where we have cash flows that come in or out. we have the opportunity cost of capital, which is our rate, that will occur over time. The time then will determine our present value that will then help us define our net present value based off of our total cash flows that occur starting now. Lupita, remember we talked about period 0 just a second ago. This is period 0 right now versus periods 1 through 5. I keep hearing something go ding ding. Oh, people are joining us. Okay, got it. All right, so let's wire this thing all together. First thing I remember seeing is up in the problem is that Lily's Laundry had assumed that its rate would be a 6% rate. The cash flows that it would get would be equal to all of these revenues. Imagine someone comes in and they hand you the $1.20 to go to get the steam shirt all year long. Then that gives you $9,000 in new cash. New cash flows out would be the sum of you have to pay that employee. Then if we did take on new SG&A, sales, general, and administrative expenses, and we do not include depreciation, this one here, we do not include that because that's not a cash flow. But if we borrowed from the bank, we would have to actually pay that cash flow. So our expenses, oops, I realized I missed up on top. Let's go ahead and redo that before I make that mistake. I pointed the wrong line. There you go, that one. Cost of goods plus SG&A plus interest expense. And then finally, your last cash flow would be this tax. So that in any given year, we have brand new cash flows equal to $5,930. Notice that that amount is more than our net income. The reason being is we've adjusted the income statement to get to cash flows by accounting for the fact that depreciation isn't actually a cash item. If we go ahead then and apply these, we can look across time, and these are then all the new cash flows we get. Notice it's bigger than that profit number. But how is it that we can get those cash flows? Because right now, the company is proposing to spend $6,000 on construction and then $8,200 to buy that new steamer. So it's going to cost $14,200 right now. You get nothing right now. You spend $14,000 right now. And so in essence, it costs $14,000 to get back $29,000. On a non-adjusted basis, it still looks pretty good to us because we spend 14 to get back that 29. It should still make us a net 15, but that doesn't account for the fact that these dollars that come further and further away are worth less and less in present. So what we want to do now is use our present value functions. So if we go to our favorite financial functions within Excel and we find our present value formula, what is the rate? 6%. I'm going to put the fancy dollar signs around it to fix it. What period? This is period 0. We're going to leave payment blank. And then here's the one trick that we're going to reincorporate again. I'm going to hit minus and then choose cash flows net. Again, to switch the sign in Excel. And what that tells me right now is, as you might imagine, if right now you get nothing, and then right now you spend $14,200, that's a cash flow net of $14,200, which means your bank account is going to go down $14,200 right now. But why do you have it go down? Because in the next period, period 1, at a rate of 6% again, if I now have to wait one period to, I'm going to forward through to the future value, and again hit the minus sign there. If I make 5930 in a year, today that would be worth like 5595 to me. Because I built my formula so nicely, I'll show it to you all this way, this is sometimes easier to see. Here's what I see in then the fifth period. At that same rate of B50, 6%, when this is 5 periods away, I have no payment, but I switched the sign on this 5755, tells me that the present value of the 5755 in 5 years at 6% would be like $4,300 today. So that the NPV is just equal to the sum of all of your present values. So in essence, what we see is it costs us $14,200 right now. We get back approximately $24,000, which means 24 minus 14. This is a project that gives us a positive NPV of $10,000. The last thing that we want to look at then is what's called the IRR. And what's nice about this is a very simple formula called equals IRR, where we go ahead and put a parentheses and it just says, what are the values you want me to calculate? And the values that you're going to use are the cash flows net. So when we use the cash flows net and calculate for the IRR, we get an IRR that's pretty massive at 30%. And the way we think about this, if this is greater than 0, you have a positive returning investment. And if this IRR is greater than that rate, which in our case is equal to 6%, then you have a positive returning investment. Before I go ahead and log or stop the recording, let me go and check what your PDF said, because my number feels a little bit heavier than I thought it was going to be. Let's just make sure I didn't make a mistake. And this time, if I did, let's correct it before I have to record a supplemental video. Let's see, look in here. 61.35 and 18%. Yeah, I missed on something. What am I missing here? 43.90, 15.40, 78.12, SG&A. Here, let's put this one over here. Put this one over here. Oh, you know, on this one, looks like I have the wrong costs. I have reconstruction 10,000, the steamer at 8,200. Okay, so I made slightly different assumptions the last time I did that problem. So I'll go ahead and save this total spreadsheet. I'll put it over the top into your Teams folder, and then everything should match to what I did here. And then we can have an excellent mechanism called capital budgeting, by which when we take a problem and document the assumptions, using what we know about the income statement, converting it into cash flows, and then solving for net present value using our time value of money techniques will allow us to interpret and make the decision that says, Lily's loving laundry. It makes a lot of sense for you to invest in buying this steamer for your customers, because it will return for you significantly more than you need to invest. And stop recording.